So for a back test to be effective, number one, I have to clearly define what it is I'm testing. Number two, I have to actually have a logic to it. When I say logic, I don't mean rules necessarily. I mean there has to be some explanation of why the strategy works. It shouldn't just be I put an indicator on the chart, then I combine it with another indicator, and it looks like it works. I have to be able to figure out the why. Even if I can't figure it out precisely, I still need to generally know why the strategy is working. And that is the part that I've noticed personally that most people do not do. That's true as well. Now, that means that if I design a back test, based on what you just said, Jen, that's a good thing to point out. But you can actually address that if the news is known in advance that it's going to come out. You could design a strategy that will automatically not trade for pre-announce, for any news announcements that are already known in advance to be coming out at a certain date. Or you can program in certain criteria to detect unusual activity and to adapt the strategy at that moment to do something different than it would normally do. In other words, you could say if there's a sudden increase in volume of a certain amount, which would necessarily be what would happen if there's surprise news, volume is going to go up a major factor. My my analysis says that usually the rate of volume for that particular time of day will probably go up tenfold over what's usual for that time of day if there's a major news announcement. So the system could actually detect that there's massive increase in volume and there's a sharp increase in volatility that would be unusual for that time of day for the stock. So it's not really saying which direction the stock's going. It's just saying, relatively speaking, relative to the amount of volume and the average range of volatility at that time, if we if we if we were to do computations based on volatility, range, things like that as percentages of what's happening at the time, we could define something that's normal for a stock, and it's actually pretty easy to do that. And that would mean that it'll be fairly easy to recognize if a stock's doing something very unusual. So it's very easy to program um, unusual activity detection into a strategy if you want to. But that aside, it won't have any control over what the outcome will be. So in other words, if that news comes out, even if the system detects it, the only thing you should tell the system to do is to exit you right away as quickly as possible out of the trade, even if it's winning. It doesn't matter what's happening. You want the trade to be exited if there's surprise information, because obviously the system is not designed to interpret that information. It can't, unless it can read headlines and interpret that sort of stuff, it wouldn't be a good idea to let it keep running because it would just be random chance at that point. However, if it's a pre-announced, if something is going to be announced, just tell the system not to trade. In other words, you can program a strategy not to trade a strategy where it's going to hold a position through earnings, as an example. Okay, that would be pretty straightforward. So with a back test, if I'm curve fitting, that just means that pretty much I'm just fitting the data to whatever I see here. There's not actually some thing that I'm aware of that I'm exploiting. There's nothing like some sort of, maybe some stock has some sort of rotation out of one fund into another that I'm trying to exploit, and I know when that's going to happen. Like for example, um, for commodities, you would have in the old days what they would call the Goldman roll, which would be Goldman Sachs rolling its commodities fund out of the expiring contracts and buying into the next contract. And what that would, of course, would do is by selling the expiring contract, you would depress the price of that, and buying into the new contract would increase the price. And for years, there were a lot of traders who basically will wait to the expirations of these contracts, and they would come in and basically they would short sell ahead of Goldman Sachs if they had some idea when Goldman would start doing their roll. The trader would short sell the expiring contract and then buy into the future contract, the next one. Um, and the idea was very simple. The one that lost money because it was getting depressed, they would make money off of the decline, and they would make money off of the incline of the other side. Now, over time, Goldman and other funds that did these sort of strategies got smarter, and they developed ways to obscure what they're doing or to offset some of the risk. So it's not as lucrative as it was, but there were a whole generation of traders who did trades around stuff like that. Okay, so just pointing that out, that would be an example of something where you actually know a situation and you're basically designing a strategy around a known situation. Okay, so let's just go over some examples of typical strategies that people would use for backtesting. So or people would develop into a backtest. So let's say I want to go to a very common tool. Let's say we are doing a MACD strategy, okay? So what I did is I added this onto Thinkorswim. It's on a daily chart, so we'll just go with that. This is the MACD strategy. Here's what it's doing. Okay, right now it has long entry and short entry. Notice that it says auto. What that basically means is that whenever it buys, it's automatically entering into a long position. Whenever it sells, it's automatically entering to a short. So in other words, it's not buying and then selling to exit. It's reversing the position. So it's always in. Um, so it's always in a trade. Now you could change that. Here are the settings: fast length, slow length, MACD length, and then you can choose what type of average. Let's say we want a Hall moving average because that will change faster, or maybe we want a weighted average, which will be more accurate of a measure of what's happening because more volume, the more important. So let's go with that one. Okay, so we're going to go with a weighted moving average to be added to the MACD. Now the MACD is a standard tool. Lots of people use it. Most of you probably used it before. And up above, I can see the actual results of the strategy. It says floating P&L, FPL is $9. Okay, this is based on 100 share trades. This is just a back tester. Of course, it's not real. Now, I could, and you could actually have this signal for you to buy or sell. You could include it or incorporate it into whatever you're doing if you wanted to. But if we look at the results, if in 2 years' time, the most that we were able to generate um, was or is $9, that's not a good sign, right? That's not a good sign that we've got a good strategy. Although I think we're actually down $612 in the current P&L. Let's see. Oh, no, that's right. No, that was correct. We were down $600, but that short actually made back a lot of the money. So as of right now, 2 years worth of work has yielded $8.20. Now, of course, none of us will be happy with that. We would say, man, that's bad. Why would I want to waste my time doing this if it's going to generate only, um, only $8? Sorry, something just went off in the background. It caught my attention. One moment. Okay, just want to make sure I heard an alert go off. Okay, so in short, a lot of commissions for sure. So obviously this is not worth the time, but here's where our creativeness will come in, right? So let's suppose I'm thinking about this like a standard person that I'm going to encounter in life. How would I approach this? So you guys type in, if this is the strategy that we're going to apply, what are some of the things that you guys think we could do to this strategy to potentially improve it? So just type out what you think could be done to improve this strategy or potentially improve it. Sure. Adjust time frames on the reversals. Okay. That's complicated, but sure. Anyone else? Like, what are some things that you honestly could think of that come to your mind, not to mine, but how would you usually address this? Like, limit losses, I see, but what are some things that you would look at? Okay. Now, here's just based on my personal experience, here's how the majority of people that I've encountered in my life who are trading on their own, I'm not referring to necessarily professionals, but I'm just saying people who are trading on their own, trying to make a buck. Here's what I usually would see. The first thing a person would do is go here, go to the settings, and change the settings. So we tried a weighted average. Let's try a haul. See what happens. Right now, the haul is down $5,000. So that doesn't seem like that worked at all. All right, so then they go and say, all right, well, let me change it again. Let's try the exponential moving average. Okay. Oh, that actually is in a profit. That's actually in a pretty good profit. $3,568. 2 years time trading 100 shares of a stock of this price. That's not terrible, right? Well, let's just try another one just to see what would happen if. So we tried weighted, we tried Hall. Let's try Wilder's. I don't even know what a Wilder's average is. Okay, that one's down $4,400, so that didn't work. So let's try. All we got left is simple. Let's try that, and that's up 2,300. Okay. Now what did I do? All I did was change the settings of averages. I tried different averages and got different results. Lots of different results. However, again, one of the shortcomings here that we have to acknowledge is that I'm doing these adjustments on data that I already have. I'm just changing the settings from one thing to another and seeing what the results will be. But I didn't, if this were real life, I wouldn't know how the stock is going to ultimately look for 2 years straight. There's no way I could actually anticipate that. So, how would I be able to do this thing that I'm doing now in real life, in real time, under the real market, if I don't know this information in the future? Already, I don't already know what's going to happen. That is the dilemma of all backtesting, one of the dilemmas, because what we are doing is we're taking information that already exists and we're changing parameters to give us the best result on the information that already exists, which means that if trading were done this way, if this were the actual way trading was done, where someone says, okay, here's a set of data, and what I want you to do is design a strategy around this data, and whoever gets the best result, you're going to get the whatever the result is. Well, of course, all of us could figure out a way eventually to create a profit off of this existing data because, again, we already know it. We already know what's there. And all we're doing is changing the inputs into this variable until we get a result that we want. But again, that's not something you could actually do in real life because trading is always done going forwards, not going backwards, right? We look into the future. We trade into the future starting from the present. We don't trade the past, right? So changing settings, while it seems like it makes sense to do, isn't really doing what I think it's doing. If I'm not thinking about this the right way, all that I'm doing is basically adjusting numbers until I see something that looks right. But here's the other question. Let's suppose, hypothetically, that I did have some systematic way of anticipating future stock behavior. In other words, if I could accurately figure out to some degree of certainty what the stock market is going to behave like for a particular period of time. Like, in other words, if I can make a 2-year forecast, not a forecast that says, hey, we're going to go from here to there and then back down, but something more like this stock is probably going to be trading in a wide range. There's a lot of things that could make it go sharply up and sharply down. So therefore, if that's the situation I'm expecting, this might be the type of strategy that might be suited for that. Now, if I could do that, then I might be onto something because I'm making a forecast first and I'm choosing a strategy that's designed to take advantage of the forecast. Okay? So let's just kind of summarize that point really quick. What I'm basically saying is this. In order for any strategy to really work, it has to be based on some projection into the future. You have to literally look at what the potential would be for the future. The only way any strategy really works is if it's somehow able to project into the future what the stock market, what the stock might act like, what it might be doing. Now that may seem like that's far-fetched because you may say, well, how could you possibly do that? I mean, no one knows the future. That's right. No one knows the future. We don't know exactly what's going to happen. But what if we can accurately project what's likely to happen? There's a very large difference between likelihood and certainty. Certainty means it will happen. Likelihood means it probably or should happen or it might happen to some degree of certainty. So, for example, today we had Bullard speaking this morning, right? I didn't know that he was supposed to speak this morning because I didn't see it on any calendar. But once I looked around, I found that sure enough, as some of you point out, there were places that announced very clearly that he was going to speak. Now, is it guaranteed that he will be there, that nothing will stop him? No. But we could realistically say that's a certainty that this person is scheduled to speak, and the probability that they will not be there is very, very low, low enough that it's not worth considering. But of course, if anything were to change, we probably would find out about it before the event was to start. In other words, it's unlikely that if Bullard wasn't going to speak, it's very unlikely that there wouldn't be some announcement that says, hey, Bullard was supposed to speak, but unfortunately this happened or that happened and he's not going to speak, right? There usually would be some lead up before the event that lets you know that it's been canceled or the person's not going to be there or whatever. Okay, so that's something that's as close to certain as we can get, right? But when it comes to the market, we know by default that it can't be that predictable because if it ever were, then basically you would know because there'd be people who could do nothing but make money. But that's not the way it works. Every professional regardless of how successful they are, points out the fact that you can't have perfect um, results. You can never absolutely know what's going to happen. You can know what the factors are that drive a stock price. You can know how those factors generally affect the stock price, but what you can't know is whether or not those factors will, in the absolute sense, do something to the price. So we can know how highly likely something is. For example, if earnings hit, if we look at this chart, most of the big movements that we see are at earnings. Well, actually, sorry, no. In this case, they're all at dividends because this company pays out a huge dividend. So the stock goes ex-dividend here, right? This is the date of record, ex-dividend. And in case anyone doesn't know, basically what this is saying is if you don't have the stock going through dividends, the dividend, then you won't get the dividend. But as dividends go, all that's happened here is the dividend has literally been removed from the price of the stock, and the stock is readjusted downwards, so you just get money in your account, but your share value goes down proportionately. So every time this stock has a dividend, usually you get a sharp decline in the price of the stock, and it's usually exactly in proportion to the dividend amount, right? So since I know that's the case, there are a couple things there's a couple things I could hypothetically say, well, maybe I should try this. So if I don't know much about dividends, one of the things that might come to my mind is, wait a minute, if the stock always goes down like that, or usually does, why not short sell before the event and then hold through? Now, for those of you who understand dividends, you know that you can do it, but you'll get penalized for it because you will be short the stock, so therefore you're going to owe a dividend to the person you borrowed the shares from, and that's going to come out of your account later. So yes, maybe you'll have a profit. You will on paper have a profit at first. So if you exit the trade after, whatever profit you made, you do keep, but you still have the IOU on the back end, which says you still have to pay back the money, no, whatever amount you the dividend would be for. Okay, so I know that might be a little confusing. I didn't want to get too far into dividends, but that is basically how it works. Okay, so in short, um, if you do a trade that's short going through dividends, you will collect a profit at first if you exit and take the profit, but you still will owe the dividend back later, and it'll come out of your account. So let me ask you guys this question. Hypothetically, what if you found out that usually for this particular stock, once the dividend hits, the stock usually moves farther in the negative direction than what the dividend suggests should happen? In other words, the dividend is $17 a share, but the stock actually moves more than $17 a share. And the reason why, well, I'll go over the reason why in a second. But if you observe that, if you check that out and figure that out, could you possibly make money off of that? I mean, what do you think? Jen is right. Yes, you can. And I actually know that for a fact because I've done it. Not on this stock, but I've done it on other stocks in the past. Once by accident. But after that, I saw the effect, and I was like, that's interesting. Now, all right, so the answer is yes, you can. You could also potentially go short after the dividend. That's correct, Cynthia. You could do that too. But the way it would work, if you're going to make money off of that scenario that I just described, the only way you can make money is if you cash out the position at a gain that's greater than the amount that you're going to have to pay to the dividends. In other words, if the dividend's $17 a share and you've got 100 shares, you know you're going to owe $1,700, right? Because you short sold 100 shares. So you know $1,700 is coming out of your account. So if you make 2,000 you're going to have to, the dividend's going to come out of your account at some point in the future, usually a few weeks after the ex-dividend date. But since you already collected a greater amount of money than what you owe, you still have a profit. Okay, now, is that a strategy that some people use? Yes. There's some people who do stuff like that. Like I said, I've done it. It's not something I focus on, but I've done it before whenever I thought that it was something I could pull off. But the trick is, it has to be on a stock that reliably does that. It will have to reliably go down more than the dividend amount is. If it doesn't do that reliably, then if you try it, you might end up basically losing money because let's say you short sold the stock and yes, they extracted the dividend from the share price, but then after the market opens or before the market opens, the stock is back up and basically, it's up to nearly where it was the day before, which often happens with the major stocks. Like the bigger stocks, like an Apple, you almost never even notice that the dividend happened because the stock oftentimes doesn't move as far in the negative direction. In fact, I would say my experience with Apple and stocks like it is that it's very unpredictable what's going to happen. So some days the dividend hits, you go ex-dividend, the stock is up the next day, right? It's opening above where you sold. And in other situations, the stock is down, after the dividends. You just never know. But in this stock's case, it is fairly reliable. In fact, I was actually watching it when it went ex-dividend just to see if it did it again, and it actually did. So let's zoom in, and you can see for yourself. The dividend is $6.40 a share. The closing price was $23.47. So let's do the math really quick. 23.47 was the closing price right here. Okay, 23.47, right? All right, so minus the opening price here was 18.15. So actually it's less. So in this case, it actually moved down less than what the dividend amount was. And it went up. And then the next day it went down. But as you can see, the difference downwards was close to the dividend, but this actually means that if you were in the stock and you collected this dividend, it almost worked out in your favor, except for now it's not, because the stock is now down lower than the dividend amount. So in principle, you lost money, even though you get the dividend back later. If the stock's down more than 640, it's not really worth it. This is actually something that I've had multiple conversations with people about, and I've noticed a lot of people are not getting that point. Actually, no, you're still up right now by 27 cents. So as of this moment, you would still have, you basically have a 27 cents gain on the stock right now from where it was at this close. If that doesn't make sense, simply put, the dividends just extracted out of the stock price. That's how all dividends work, no matter what stock you're looking at. It's not free money. All that's happening is they're taking the money out of the coffers and they adjust the share price downwards to match the amount of money that's being withdrawn from the company's account. Simply put, the value of the company goes down exactly, the market cap goes down by the amount of the dividend amount. But since the stock price has other factors that influence where it is, you don't have a perfect record here. So in other words, you don't have it exactly down 640. It sometimes will be down more and sometimes will be down less. So in this stock's case, if I had short sold here at the close and I exited at the open, I actually lost money. I would have lost about $1 per share because the stock didn't open lower or less than what the dividend was. Also, it didn't sell off, right? Which usually it does. So this is also a great example of one other factor that we have to consider, the fact that nothing is perfect, right? no matter what I do, no matter how reliably something does what I want it to do, it doesn't mean it's going to do it every time. And I have to factor that in too. So in other words, if my typical gain is only 50 cents more than the dividend, well, maybe this is not a good strategy to do because a lot of these exceptions might be more against me than in my favor. Maybe it's actually better to hold the stock altogether. If that's the case, there are ways to do that too. I won't get into them right now, but there are ways to guarantee that you only extract a dividend. But then that would beg the question to me, what's the point of being in the stock unless, I mean, to me, the only reason to be in a dividend stock is if the stock is actually appreciating in value as it's paying out the dividend. In other words, if the stock is going down in value, the dividend's not saving you. It's basically like you're owning the stock up here, and yes, in theory, you've made some money, but you actually haven't because all that's happened is that's been extracted from the price. So you might be slightly up, but not by much. So if you're going to do dividend stocks as an investment, make sure they're actually appreciating in price. Apple, Microsoft, et cetera, are good examples of stocks that are worth holding that will pay you a dividend. But stocks like this, I would say when it was going up on this side, yes. But since then, no. It was only good on this side. Once you crossed over this threshold here, that was literally the end of it. And ever since then, it's mostly been on a downtrend. Okay. Anyway, that's another topic. So if I'm designing a strategy around this, as long as I have some situation that I'm aware of, I can test it, I can look at what happens, I can know a lot about it. But if I'm just basing my strategy on moving averages, which is what the MACD strategy is, it's not really referencing anything important enough that I can expect that I can get good results from it anyway. So I can actually improve the strategy nevertheless. And one of you mentioned one way you can do that, which is limiting losses. Even though the strategy by default is not likely to be a winner in the long term, this strategy could potentially be improved. And the way to improve it, to some limited extent, settings do matter. I will not say they don't. In other words, there are some differences between these types of averages that would be substantial. In other words, there's a big difference between a simple moving average and a weighted. And in my opinion, the weighted is always better because it's a more accurate gauge of what the average price actually is. So I would rather go with that, even if it doesn't result in better performance on the numbers, as long as it's actually a more logical selection, then I can go with that. Um, Obviously, the strategy would have to be adjusted to not be in a short position, which it was right here. It got short right here just before the dividend. So right now, and as we speak, the short seller, would owe this dividend back later. So you would have an instant credit in your account, which if you could figure out a way to make a good enough return on that credit before the dividends due to basically equal it, then you wouldn't lose money. But how would you do that? That's another story. I don't know of any way to do that effectively. So if that's not the case, then you're going to owe that money later. So you just better hope that the stock keeps going down so that when you have to pay back that money, it's not going to be more than what you're already up. But of course, who knows if that's going to happen, right? So in short, great idea on paper, but once you look into the details, may not be the best strategy to apply. But if you find a stock that really has a tendency, or for some reason you expect that it's going to exceed the dividend amount in a downward direction, which occasionally I've seen something where I was convinced that would happen, then sure, you could do that. But that would be a few and far between type of trade. And of course, you couldn't hold overnight anyway in the day trading strategy, so this wouldn't work anyway. So let's see what we could do to improve. Firstly, let's just settle on leaving it alone with the stats it's on, but let's just see if we can do anything to improve it. So the way that we can improve is to manage our losses. Okay, so I'm going to go to show report. Okay, now show report, as the name implies, is just showing me the results of what happened. And it's showing me the entries, the exits, etc. But when I get down to here, this shows me a summary. It says my total P&L is negative $644. The best trade was 1,923. And we have 44 transactions. Yep, I got you. Now, it's just the stock's down so much. That's what I'm saying, Jen. Like it hasn't lost 96% of its value, but nevertheless, it's lost a lot of money. So, in short, there'd be better stocks to be in that would still make you money without going through all that headache. But again, that is my strong opinion that it's not worth it unless you're making a return, an absolute return. All right, so if we look at this strategy report, it gives us an idea of what type of results this strategy has been generating. Now, I won't have enough time to go through. Yes, that's true. They usually do for good reason because they don't have any value. I mean, that's the reality of it. They don't have any real long-term prospects usually. So when I look at these results over 2 years, you can see like the individual trades. So here's one that lost $328. Here's one that lost $949. Here's one that lost $297. And so forth, right? $1,000. Now here is the question I would ask. Okay, I know this strategy is not perfect. I know this strategy is not something I want to hang my hat on and build a career off of. I want to use something with more exploitable details, something where I could know more about the situation. Hold on for 1 second. Okay, sorry, I was answering a question. So I prefer, or not just I prefer, you always want to, it's essential that you develop a strategy based on some scenarios that you recognize, like situational awareness is basically what I mean. um, if you know how stocks usually perform intraday and you pay most of your attention to some of the indications that you might have a strong day in a stock, etc., that's something you can actually exploit. But you still have to know what should happen, and that's not as easy to define as what we have here in the MACD strategy. Okay, but let's say we're just using this and we're saying, okay, well, I know this is not ideal, but how can I improve this? One of the things we could definitely do is try to cut some losses. Now, if I were to take this file, which I'll do right now, and let's go to, well, let's do it right there. So let's do HTML, right? And now, yep, it can. You have to program the strategy though. Like you have to actually create it. So now let's do something else. Let me go to Google. And let me see here. I don't have this on the screen. I'm just importing something really quick. Computer's a little slow right now. All right, so now I've imported the data. All right, the data is now on this spreadsheet. And let's suppose I just do something very straightforward. I can see what my P&L results are. Here's my trades that I can see. So I'm going to go down here. I'm going to select all the trades. I'm going to copy them. Then I'm going to make a new spreadsheet. I'm going to paste, and then I'm going to sort them. Is it A to Z or Z to A? Yeah, there. No, that's the wrong way. Well, actually, that'll still work. So I sort them from the highest result, best result, to worst result. Now, here's what I don't know. I don't know how much of a pullback in the stock is necessary to make any of my better trades. In other words, these better trades up here, let's just say we stop with the 1, 2, 3, 4 top 5. I don't know how much of a drawdown was necessary before that was generated. In other words, that $1,900 gain, how far did the market go against us before we saw that gain? Or that $1,200 gain, how far did the market go against us first before we saw that gain? That I don't know. I don't know what the number would be for that. But I can find out because I have the full report, right? On the page, it actually shows me where I got in, what date, what price, everything. Tells me the whole shebang, right? Price, shares, date, right? So I know everything. Since this is daily, all these are at the end of the day. The strategies run on the close on Thinkorswim. So now that I have that information, folks, I can actually dig into this and figure out, all right, where can I cut my losses where I would actually get a better overall performance? And one thing I know for sure is this. There's very little chance that the worst trades, let's say the bottom 5 worst trades, which are right here, those bottom 5 worst trades are worth negative $4,794 in losses. So if my P&L, according to Thinkorswim, was 644 negative, if I were to figure out a way to get rid of these losses, or at least to reduce them in size to something much smaller than what they are, that might be enough to switch me over from being in a loss to a profit. Now, of course, we're still doing a back test, but there are ways that we can actually intelligently look at this and say, well, maybe if we change the strategy to, instead of doing the same 100 share position every time, maybe we should adjust the strategy based on something else. Like, in other words, maybe we should trade fewer shares when the volatility is high and trade more shares when the volatility is low. Maybe we should adjust our risk tolerances to match the amount of our trade sizing to match the amount of risk, so that we can essentially normalize the results. Like, we can get consistent losses of a particular size range, and we just leave the profit side more wide open where we might be able to make more. Only way we can figure this out is if we actually examine the data. We look at how far does the market typically go against us before we generate a win, and for our best wins, how far did the market go against? Now, if I find out that the market has to go against me $1,000 before I can make 1,900, although that's not necessarily a bad thing, since I only see one $1,900 winner, that suggests that that's a lot more than what I could typically expect to make. So therefore, I wouldn't want to base my strategy on risking enough to justify that. In fact, I'd rather get rid of that win altogether if necessary to reduce my risk exposure. I'd rather have gotten stopped out on that one at a smaller loss if necessary than having to take that bigger risk, which is going to add up to more losses for other trades that are not going to end up going so well. Okay. Now, I'm jumping through this, but what I'm trying to point out is the foundation of backtesting or developing a strategy is you need to make observations. You need to look for situations that are repeatable where you understand what's going on. Dividends are something we absolutely do understand what's going on because it's a very mechanical process. It's based upon rules that happen based on legal, legal requirements, procedural agreements, and things like that. So it's not like it's random. It's not like dividends just happen out of thin air. They're declared in advance. The stock price is adjusted in a particular way. We know those things. It may not be something we can exploit, however, but it's a good example of something that we can be aware of and we can look for ways to potentially exploit it. Now, of course, obviously, something like dividends, since it happens so often, clearly lots of people have been looking at this over the years, and I'm sure they've already figured out their own ways of doing it. And I know of some ways. So it's not like we have to reinvent the wheel. We could literally just look it up. We could literally just Google it and say ways to exploit dividends. And someone might say, okay, here's one way that that's been discovered that you can do it. But when it comes to this part, the losses, this part is actually not as hard as it seems. In other words, a lot of these losses, when we look at their size, let's say we did something very simple. Okay, this is not the way I would recommend doing it, but let's say I select this data and I ask what's the average. The average is negative 394.79. Now, all I have to do now is ask myself this question. I see that negative $394.79 is the average size of the loss, but do I need to take that much risk? Is that necessary? Because let's do the math on that. How much is a $394? $394.79 means I let the stock go against me basically $3.94 since these are 100 share trades. The question would be, is it necessary to risk that much? Do I need to have a risk of $394? And the answer might be yes, might be no. Who knows, right? We have to find out by looking. But let's say that it is. Let's say that $394.79 is exactly how much we need to risk. That means that every trade that has a loss greater than that, we could cap it off to $394 and change. So let's just say, for argument's sake, we cut these off to $395 each. So now instead of losing $1,273, I lose $395. If I do that, and I add up this total with it, sorry, this is not negative, so that's going to mess up my calculation. So if I add these plus these, my sum is now negative $7,924. The previous sum was negative 11,000 something, right? So if this sum is negative 7924, this is my losing side. So let me write that down. Negative 7924 is my losing side. But my winning side here is positive 10,410. So if I find out that none of these winning trades, not a single one of them, ever required me to have a loss that was equal to or that was greater than $395, I've just figured out a way that this strategy might work. Now I can't, obviously we're still back testing. I'm still using data that already exists. But one thing about stocks is they do tend to normalize after a while. They do tend to get into patterns of behavior. So it's not likely that we're going to see dramatic shifts in volatility in certain stocks. Zim, yes. Zim is a very volatile stock, so this would be one that I would expect the volatility range to be quite dramatic. In other words, volatility can change over time quite a bit for this stock. Not going to be quite as dramatic for a stock like Microsoft or Apple. It will be pretty contained. Just like the S&P, it has its volatile periods, but in all, it tends to stay within certain parameters. If I can adjust for the volatility component so that my trade sizing varies based on the amount of volatility that's present in the market at that time, I could basically still keep my losses to a certain amount because, again, volatility can move things in either direction. It can move in your favor or against you. So it doesn't mean that suddenly you can't win because the volatility goes up. It just means that you have to adjust your trade sizing and targets accordingly. So even this basic rudimentary system, which is not anything skilled or sophisticated, even this can be adjusted in ways that could actually become modestly profitable. It's not ideal, and it may not be able to generate results that are really worth it over time, but you could actually develop this into probably something that's profitable under certain circumstances. Now, I say certain circumstances, meaning that clearly it can't work for every type of stock. The stock will have to trade in such a way that it's congenial to this. My guess is that a stock like IBM might actually do well with a strategy like this because IBM tends to have these big swings up and then big swings down, but doesn't really go anywhere. It could also work well for a stock like Tesla if we're looking at it over a longer term chart. I don't know about intraday. But by work well, I don't mean it's going to exceed a truly well planned strategy using good statistics, using good risk management, using good information to anticipate things, to project things. Those are always going to be strategies you want. This is purely a reactive strategy. It has no predictive power whatsoever. It's not making anything more than measurements of what you already know. And for that reason, it's always going to be limited in its impact, in its ability to make money. But you can still learn how to manage money by using something like this, by trying things like this, by looking at data and learning how to actually manipulate what you're doing to generate better results using the data you have. Correct. So once you learn, but actually, Clark, just to be clear, we know that already, but I was wondering, are you saying that for some other reason or just making a comment? Okay. So once we know how to manage our trades better, naturally that's going to improve whatever we're doing, whether, if we have a better strategy, a better approach. Most of you are probably using strategies that are extremely technical in nature, meaning that you're very focused on just, charts and moving averages and stuff like that. If that's the case, just remember that no matter how many of those you use, it's still not going to do anything more than tell you what you can already see, right? It can summarize it, it can improve your overall comprehension of it, but it's not going to make the market change. It doesn't make the market do things that it's not already doing, and it's not possible, whether it's a VWAP or Bollinger Bands or whatever it is, none of those things can do anything more than what they're capable of. So if we're using them, we use them to help us recognize something that we already are aware of as a pattern in the market, as a way things typically perform. And then we try to find situations where those patterns, those behaviors tend to work more favorably than not. So this strategy doesn't know any of those things. It doesn't even consider those things. So therefore, there's no way of doing anything that I just described. So what we can do is this. Here's what I want you guys to do. All right. If you have Thinkorswim, the way I did this, just so that you see it again, is I added a strategy first. You go to Studies, Strategies, and you select the strategy. You add it to the chart, right? Maybe you make an adjustment or two. Now it's on the chart. It's going to run automatically. From there, what I want to do is right-click on the last one of these that I see, which is this one right here. There's no other ones after it. these little things on the screen. I hit show report, and it's going to pop up here. Then I go export file. I think you should either save it as a CSV or HTML, it's your choice. But once you save it, it's going to be in your documents folder, and you can open it in Excel or open it in Google Docs, whichever you prefer. Once you've opened it, now you can actually look at the data and start to investigate. You can actually look at all of the entries. You can even see them on the charts too. So in other words, I can look at a particular entry like this one right here. So this one was a long entry of 100 shares, right? And I'm looking at how far things go against me. So I go to this bar, and I think it's saying that I don't know if it's saying the trade P&L. Okay, so based on what I'm reading, it went from $816 here, right, down to negative 1,610. That's a lot. And then it came back up. So that means that even though this trade didn't result technically in a loss, right, that closed P&L was $33. If I look at that result on the screen here, where was it? Here it is, $33. This one right here. If I actually look at it, while it says that I never lost more than, I gained $33, what I also noticed is that it went a lot against me before I made that $33. So was that $33 actually worth it? The answer is no. That means that when I go through my results, if I say I'm cutting myself off at 395, I would have been cut off at 395 on this trade because the market went $395 against me. That's why I said we have to actually find out by looking at the trades individually how much the market had to go against us for every gain that we made. And if we find out that some of these smaller gains required bigger losses, then we have to consider, well, if I find out, for example, that these top 5 gains didn't require the market to go against me more than $70, then I might consider, well, what would happen if I cut myself off at $70 for all of these? What would have been the end result? Maybe it would have been a positive, maybe it would have been a negative, I don't know, until I add it all up. But again, you can't expect this strategy is going to make you money, and because like I said, I just did a quick analysis here, but once you start to go into detail, you can see that it's not that easy, right, to know where to cut yourself off. It's just a best guess, right? So we have to first actually look at the degree of negative that we get on each trade. So here's another trade. And this is probably one of the bigger winners. This one, the trade P&L was 1923. That was the best winner right there. So if I look at that 1923, guess what? When we got into that one, this is a long entry. The absolute most that the stock went against us was about 24 cents to get that gain. And that's probably what you're going to see a lot, that the biggest gains often don't require as much risk as you would think. So what I usually, when I've trained people individually, this is one of the things I always point out, that what you're trying to do basically is figure out how to flatten the results for the stuff that's below your best results, and basically see if there's a way for you to carry that forwards into future trading, because we know we're back testing it, so we're trying to figure out ways to actually identify the volatility, to calculate the amount of risk we should take, to basically figure out how we could know to some degree of certainty how much risk we should be taking given the current market conditions that we're observing. So that means that obviously the strategy is going to have to be made to be adjustable. It has to have some sort of adjustments where it changes the sizing of trades. It may change the frequency of trades. It may change the preference of where the entry is. These are things you would have to enter into a strategy like this. But obviously there is almost certainly a way to make this generally profitable if we're looking at a certain type of stock. but it's not going to make a lot of money. I can promise you that. Like it'll be a small edge perhaps, but if you can then introduce some better information about a stock, like maybe some fundamental data, maybe some other observations that you've made over time, those can be incorporated to greatly improve the results. So again, it's always a process, but if you can start from a set of circumstances that are clear, that you know why something's happening and you know what usually happens when it does, if you can start from there, that's where you want to build a strategy from. In my strong experience, that's what you want to start from. If you just start from a basic technical strategy, you're going to have to do a lot of work to figure out how to get it to work its best. But if that's where you have to start, then that's where you have to start, right? You just have to do what you got to do. All right, so I do still say this is great practice to learn how to manage trades better by experimenting with something that you know is not a blockbuster, fantastic strategy. If you can figure out how to manage that and still be able to walk away with a decent profit, then you definitely have learned how to trade, and now you can actually use that in your current trading to improve what you're doing. Basically saying you're going to figure out how to get yourself out of a losing trade faster. And eventually, as you do that, then you're going to learn how to avoid a lot of trades that never really would have come out to a profit anyway. Okay. All right. So hopefully that helps. So just experiment with that, and that should be helpful. Other than that, folks, I do got to run here. So I will upload this video later on YouTube over the weekend, and then I'll share that with you guys next week, okay? No trading tomorrow. Markets will be closed. So remember, just sit back, relax, drink a drink of your choice, enjoy the weekend. Yep. Have a great Easter weekend. I'll see you folks on Monday.